Elon Musk, compensation case. $56 billion struck down by the court. Elon's threatening to leave the company. Pandemonium, mass hysteria. What happens next? Tune in to find out. So let's say you had $10 and I told you if I can turn that $10 into $100, would you be willing to give me $9.40? So ultimately, I made you 90 bucks. And all I'm asking for is $9.40. That is the crux of the case here. If you answered yes, you would absolutely approve of Elon Musk's pay package. On the other hand, if you answered no, I guess you just don't like making money. I honestly can't figure out why anyone would answer no, but be that as it may, there is no downside risk here. You're walking away with the $10 regardless. So it's an asymmetric scenario. I get nothing unless I make you something. So here's how I'm going to structure this, guys. We're going to do who, what, when, where, why, how. And if you stick to the end, I'll give you my take and what I think is going to happen next. First, you need to understand who brought this case in the first place. There's a gentleman by the name of Richard Tornetta. I personally don't know much about this individual. If you look at news clippings, they talk about how he was a heavy metal drummer. I don't know what the heck that has to do with anything, but he is the plaintiff along with other shareholders. Number two, board of directors. They're the ones that came up with this plan, and it mimics the plan that they came up with in 2012. For those of you who don't know what a board of directors is, those are the independent representatives of the shareholders. They're actually voted on and voted in by the shareholders. So what they do is they act as kind of like a check and balance against management to make sure that the shareholders' interests are aligned with the company's interests. Number three, the obvious. Elon Musk, the chairman and CEO of Tesla, he is the person in the crosshairs in this particular case. And I think the problem here is if you read the news, you really don't get a good sense of what exactly is going on here. They make it sound like Elon Musk and his brother pushed this through, which is totally not true, and that he basically wants $56 billion in cash or he's going to run. That's also not the case. So next we have to talk about the what. When we talk about the what, there's three pieces that we're going to talk about here. Number one, this is in what are called stock options, in particular, call options. An option is the right, but not the obligation to purchase or sell a security. So in this case, these are call options, which is the right to purchase stock. And the only time it has value is if the stock goes up. So let's give a simple example. It's called a strike price. That's the price that you can pay. So let's say we had a stock with a strike price of $50. That particular stock is now at $100. That means my option to purchase the stock is worth $50. Now, depending on how I choose to receive that $50, I could get it in stock or cash. If I receive it in stock, I would get 1/2 of one share. 100 times 0.5, that's $50 worth of value. Then I would take however many of those options I held, let's say 100, and then I would end up receiving that number of shares. So in that case, I would receive 50 shares to be made whole if I had 100 options, okay? Number two, this is the only form of Elon Musk's compensation. And this is very important for us to understand. He's not making millions of dollars a year and getting this on top of it. This is his only form of compensation. And really what management is doing with the board of directors is they're saying, we're aligning the shareholders' interests with management's interests. Meaning that if the company performs well, obviously the shareholders will benefit. Now, number three with the what is very, very important, and that's the mechanics of this. So, number one, it's aligned with shareholders because it's purely performance-based. The metrics that actually have to be hit for Elon Musk to get all of these options to vest, basically to get these in shares, are metrics of market capitalization, as well as operating metrics, revenue, and EBITDA. All right, so very important to understand here. This actually mimics Elon Musk's previous compensation package. If you look at the details right here, which were in the financial filings, which you can pull up from the company's investor relations website, you will see that the 2012 award, which was the previous award, and the 2018 award, which is the one that we're talking about here, are very similar. Now, if we look at the compensation at risk, 100%, market cap at the time, obviously significantly lower in 2012, 3.2 billion. At the beginning of this one, it was 59 billion. Outstanding shares vesting per tranche, don't worry about that. Market cap increment per tranche. So that's how much the market cap has to increase per tranche. And just so we're clear, tranche means slice in French. So you're thinking about this like a layer cake being stacked on top of one another. Now, here's the key. The previous award package was not operating milestones, it was product development. So think about like having a milestone. Hey, Elon Musk has to produce, not sell, produce 100,000 Cybertrucks. That was the type of stuff that was in the previous award. The company was at very early stages. Now it's established. Now it's operating based. So we're talking about things like revenue and EBITDA. EBITDA standing for earnings before interest, taxes, depreciation, and amortization. In this particular award, there's more tranches, so there's more breakpoints. There's 12 versus 10. This is very important. The next point, the 2018 award has a post-exercise hold period of 5 years. That means that when Elon Musk exercises these options and receives this compensation, he cannot sell those shares for 5 years. This is huge because he can't just cut and run. He can't just say, hey, thanks for everything, guys. I'm going to focus my time on SpaceX, AI, etc. So it's very, very important there. Now, here is the fascinating thing. How much shareholder value is created by the end of the award if everything is actually achieved? When we look at the 2012 award, 40 billion. When we look at the 2018 award, 600 billion. I mean, just think about that. That's what he would have to add on to the starting point. The next thing that we have to discuss is, what are all of these breakpoints? What exactly are we talking about here? So if we look closely, what we see is that it's a combination of market capitalization, basically shares times price, as well as revenue and EBITDA. And just to kind of like break this down so it makes a little bit more sense, once a market cap breakpoint is hit, also has to have one of the operating metrics satisfied, either revenue or EBITDA. It doesn't matter which one. And ultimately, this means that if the stock just rips and then they're not hitting their actual operating metrics, he's not going to get paid. So if the market just has like a melt up, but they're not actually hitting the mark in terms of underlying operating metrics, revenue and EBITDA, he's not going to get paid. So this is really good because it's very, very closely aligned. Also, so you understand, the market cap is not just one day. So this is very important in terms of how they structured it. It has to be on average at least the last 30 trading days, which means that it would have to be at that particular level for a pretty significant period of time. And then also the board has to agree that this has actually been achieved. All right, so the next thing that we have to talk about is the when. So this is actually over a 10-year time frame. And as I alluded to a little bit ago, it's a 5-year hold. Also, you have to understand what was involved in this. The board of directors had 6 months where they studied other compensation plans in order to come up with this compensation plan. So not only did they want it to be aligned with the previously approved compensation plan, they also wanted it to be aligned with other mainstream company compensation plans. Now, this is absolutely critical, and this is something that hasn't really been articulated properly in press releases. Number one, this was approved by the board unanimously without Elon Musk and without his brother Kimball. This is very important because the insinuation when you read news reports on this is that somehow, some way, Elon and his brother kind of like nefariously pushed this through. They were not involved. Number two, and this is even more important, this wasn't just like rammed through. The shareholders had to approve it. So ultimately, the shareholders ended up voting on this and they approved it at a 3-to-1 ratio. So if you look right here, you see the for vote, 63,014,339, the against vote, 23407,632. But here is the key. The votes cast in favor of approving the CEO Performance Award constituted 73% of all votes cast, excluding votes of shares owned directly or indirectly by Elon and Kimball Musk. So this was approved by the shareholders 3-1, excluding Elon Musk and his brother. All right, the next thing that we have to talk about is where. So where are these breakpoints? What is this all about? So the board determines when each tranche has been achieved. This is very important. So it's not just like random, like pat on the back. Hey, Elon, great job, you did it. They have to actually look at the market capitalization, make sure that that has been achieved. And then the revenues and EBITDA are on a last 4 quarters basis. So that's very important as well. There can't basically be like a blip up, like a one-time pop, and it's like, hey, you hit it, and then it pulls back. So that's another good thing for shareholders. Next, we need to talk about the why. So the key here is they're aligning compensation with performance. This is very important. They're not just giving Elon Musk hundreds of billions of dollars and he has nothing to show for it. There is literally zero pay that Elon Musk receives, only receives this as his compensation, which is very, very important for us to understand. So if he doesn't perform, if the company doesn't achieve its operating metrics and results, he doesn't get paid. Another thing that I want to mention is there was all this discussion about 25%. Elon Musk wants 25%. At the time that this was consummated back in 2018, Elon owned, directly or indirectly, 21.9% of the shares at the outset. So when you think about it, it's like, okay, he already owns a bleep load of shares. It's not like he owns nothing and then all of a sudden he's like, I want a quarter of the shares or I'm out of here. The next thing that we have to discuss is the how. The way that these options work is there's a strike price and then there's an exercise at whatever the current market price is. Now, ultimately, the company can do one of two things. They could actually give Elon Musk cash, which obviously wouldn't be in their best interest because that's a lot of cash, or they could provide him with shares or some combination thereof. But remember, regardless, he's on the hook for 5 years, so he's not going anywhere. Okay, but what does it actually look like? So let's look down below, and what you'll see is what has to be earned and then ultimately those associated breakpoints. So what we see at the very bottom is if all 12 tranches are realized in terms of their value, what does Elon Musk get? What do the shareholders get? So I gave that example earlier, $10 to $100. That is something that's very important because ultimately that's really what we're talking about here. So if you look down at the bottom, you see 9.4%. That's the $9.40. And the shareholder value realized would be almost $600 billion. So it would have to go from 59 billion to about 650 billion for him to hit all the marks. And then he being Elon Musk, would get 55.8 billion of value. Now, this is a very important thing to understand. I explained it in my previous video on Tesla where I did the valuation. This is a pie. So you need to understand this issue is really a matter of how the pie is sliced up. The size of the pie doesn't change. So before the exercise of these options, the pie is at 100%. It's all the investors. What we're really talking about here is 9.4% of that pie will be a slice that will go to Elon Musk. That's really what we're talking about here. So we're not trying to change the size of the pie. We're changing how the pie is sliced up. Okay, guys, next thing I want to talk about is a visual representation of the metrics, what they mean, etc. So in 2017, when this was originally thought up, they had 11.8 billion in revenues and 0.7 billion in EBITDA, basically 700 million in EBITDA. Also, at the time, it was 59 billion for the market cap. Now, when we look at 22-23, we can see that the sales breaks, ultimately 4 of the potential 8 operating metrics on the sales side have been achieved. And for the EBITDA, 8 of the 12 have been achieved. Remember, EBITDA is earnings before interest, taxes, depreciation, and amortization. And the market cap, shares outstanding times price, all 12 of the tranches have been achieved. If you look at 2023, the stock was between 657 and 830 billion of value. Hey guys, don't forget, if you like this, please smash that like button. All right, so as I mentioned in the beginning, I was going to give you my 2 cents and what I think is going to happen in the future. So what ultimately happened here was a judge in Delaware voted this compensation plan down. And the interesting thing is they said that the plaintiff should meet with the board to come to a resolution. So they didn't make a judgment. All they did was they said, you have to figure this out. 56 billion is too high. Now, the thing that I didn't really like about the judgment, and again, I'm not a lawyer, so I'm not going to opine on a legal case, but I don't think the magnitude should have anything to do with this. It just muddies the waters. What you have to look at is relative size. So it's like, if this was a $10 million company and he increased it to $100 million, no one would have an issue. But because it was a $60 billion company and he increased it to $650 billion, all of a sudden that's an issue because we're talking about a size difference. But here's the other thing. He hit the goals. And now all of a sudden when he's about to get paid for hitting those goals, you're unhappy. Meanwhile, he 10x'd your shareholder value, okay? So let's say you had $10,000 in stock, you end up having another $90,000, but you're mad that he wants to get a little bit. So would it have happened without Elon Musk? I highly doubt it. But just to give you some perspective, in the hedge fund world, the way that the compensation works is 2% of assets under management, 20% of the upside. So what does that mean? If you start with $10 and the hedge fund makes you that 100, they actually increased your holding by $90. Take 90, multiply it by 20%, you get 18. Now, what's the assets under management? 100. So you'd have 2% of the 100, that would be 2. 18 plus 2 is 20. So if that same performance was achieved at your average hedge fund, that would be a 20% or $20 that you would have to pay the hedge fund. So it's kind of ironic. It's like, okay, like you'd be okay paying $20 to a hedge fund. You're not okay paying $9.40 to Elon Musk. So what do I ultimately think is going to happen here? I think there's probably going to be some sort of resolution that will be reached between the class of shareholders that are against this currently. I don't know if it will be a reduction. I don't know if it will be a lengthening of time frame, a changing of the composition of the compensation. But I think there will be some sort of a resolution at the end of the day. Think about it. If Elon Musk decides to leave this company, I mean, this stock is going to absolutely tank. He's somebody that's the visionary. I think he's really like a Leonardo da Vinci of our times. And to not have him a part of Tesla, I think significantly diminishes the value of Tesla. All right, guys, if you enjoyed this, I highly recommend you check out the model that I just built right here on Tesla. That will give a lot more explanation and context into the revenues, EBITDA, and what it means for valuation. As always, please share this with someone that you think will find this valuable and be relentless.